Welcome, welcome everybody. Good afternoon or good morning or good evening, depending on where you're watching from. My name is Andrew Carr. Today we have Paul Johnson, who's going to give an overview of Chipotle. And what's different from the last Chipotle webinar we did is we're not going to look into what Ackman saw. Instead, what we're going to look at is how can you ramp on a name using some of the tools that are available using AI today. And so one of the things that we think is AI can help with a process, but you have to have a process. And so where does a person get a process? How do you know what to look for? How do you structure your analysis? They added a new menu item. Is that going to change things? The prices of the items went up or down. Is that going to change things? It can feel like you're treading water and you don't know where to start. Fortunately, in our Wharton Applied Value Investing program, partnered with Wharton and Wall Street Prep, we go through how to form a process for investing over the long term. And what you will learn in the course is how Buffett-style investing integrates different elements of long-term competitive advantage, capital allocation, and strategy to realize returns over the long duration horizon. And what you'll also see from the program, whether it's from our instructors here today or from the Wharton colleagues who also drive the program, is how to integrate these into a structured investment process. And so, little intro on myself. My name is Andrew Carr. I spent about 7 years in institutional investing, and I now, my livelihood is now training people who are newer to the world of investing and helping them get situated in the world of institutional investing. I'm pleased and proud to introduce Paul Johnson, who has taught at Columbia Business School for over 30 years, who also teaches the course that can trace its lineage back to the course that Warren Buffett took when he went to Columbia Business School, learning about value investing. I won't take up any more of anyone's time. Let's get it over to Paul, where he'll take it away with the presentation, and at the end, we'll open it up for Q&A.
Andrew, thank you, and thank you for the introduction. I am delighted to be here. I think probably like maybe everybody on the call, I'm intrigued, fascinated, curious, befuddled some days about AI. Certainly the headlines are everything from this is going to lead to an unbelievable increase in productivity and utopia. I've heard those stories for most of my career in technology. That one's probably not fully true. And then the other side is that this dystopia that's going to come, AI is going to take over. I doubt that's fully true either. But what I want to focus on today is taking AI related tools and seeing if they can help us in the job of being an investment analyst. As Andrew said, I've spent the last 30 plus years teaching, thinking, creating curriculum around an investment process. And I think Andrew has framed it perfectly, that the idea is how can we use AI to augment, that's the word we're using, but certainly improve the investment process. Without an investment process, I don't think you really have anything to work with. You could use AI, but it's not clear where it will take you. With a process, we are, and Andrew and his partner Brett, we're really trying to pioneer this idea of taking investment, the investment process, kind of the generic investment process, and seeing which steps are really benefit from an AI agent or an AI partner, and which steps still we're not quite there. And so I'm very excited to run through this. We came up with this idea a couple of weeks ago, and so I spent the last maybe 3 weeks augmenting my Chipotle case study to use AI tools. And I want to set that up. We'll have time for Q&A at the end, and I look forward to interacting. It'll be a lot of fun. All right, now we convince the slides to move forward. Chipotle. All right, so this is the way I want to frame the case. And I think this is close to a real world situation, or it's certainly a situation that I've been involved in many years ago in my career, and I still hear many of my students get involved with. And I'll read this because I think it's a good setup. Your portfolio manager or the portfolio manager, either way, asks you to look at Chipotle. I gave you a little information to see if the fund should invest in the stock. The PM informs you, you may have known, but the PM informs you the stock is down probably about 30% from its recent high, and she's just curious. This is an extremely well-respected company. It has made investors a lot of money over the years. Down 30 is interesting, and she's just curious if that drawdown has created a buying opportunity. And this is a standard exercise. She might send you an email, she might drop by your office, she might toss a research report on your desk and say, hey, take a look at this. And in this scenario, I'm going to assume you've never analyzed Chipotle before, and so you're kind of coming at it fresh. All right, standard exercise at fresh. She said, I'm going to drop to the bottom just for fun. She said she'd like a preliminary read by the next day. So let's say this is 11 in the morning. Hey, sure love to hear about this at the morning meeting or tomorrow midday or something. So you don't have much time to come up to speed. You've never looked at it. You're not an expert in the area. All right, now to set up the problem, I say that you have two tools. That's all. You have access to ChatGPT 5.0 and you have a financial data source. That's going to be important both as we think about AI, but also in this case. So I put down here a third tool, Wall Street. Now, I'm going to say you do have access to Wall Street, but I want to caution, certainly the young analysts, is I wouldn't go to Wall Street first. Wall Street analysts are paid to have an opinion. Wall Street analysts are not necessarily paid to have a good opinion. And the way the mind works is the moment you start hearing the opinions of the analysts, it's going to pollute your thinking. So the way I want to think about this is you're going to use your preliminary analysis internal, see what you kind of come up with, both a qualitative and a quantitative analysis, knowing that we don't have much time. And then at the end, you'll go and kind of compare that to Wall Street and see what you can glean. All right, so that's the exercise. That's what we're going to do. Those are our tools. All right, so here is the stock. It is, in fact, down about 30% from its recent high. As you can see, it was a big stock, which I'll show you in a moment. All right. So the first thing you're going to do is you're literally going to fire up your ChatGPT window and prompt engine, and you're going to type in the following. I'm an equity analyst working in a long short equity portfolio. What we're finding out with AI is setting up the persona of who you are, who they are going to imitate, is really important. In fact, we're finding out that that's one of the critical elements. As I study AI, and I'm certainly not an expert, although I'm trying to get up to speed quickly, the one thing that seems to be really important is you establish with the agent, doesn't matter if it's ChatGPT, Gemini, Claude, or any of these, you just say, this is essentially the role I'm playing. And then you want to say, what is the goal of the exercise? My portfolio manager has asked me to analyze Chipotle as a potential investment. That's all I wrote. And then I hit go. And this is what came out, which is fascinating. I put it on 8 slides so we could actually read it. I didn't do anything else. That's literally what I wrote. Now, I have followed Chipotle for 8 years, so I like to think I know a lot. So I'm gonna play referee, if you will, or kind of coach in the back to tell you whether or not I agree with it. Just now, you don't, because you're brand new to it, you don't have that benefit of that expertise, that experience. And so I'm going to be there and just kind of in the background. I'll give you my commentary as we go. All right, so quickly, core business, fast casual restaurant chain specialized in burrito bowls, tacos, and salads. Love that. I was like, boom, done. About 3,500 restaurants. Now, one of the things you'll know about AI is they have, I think it's called a regency issue, in that they do have a training date, and I think ChatGPT 5.0 was trained earlier this year. That 3,500 is a little light, but order of magnitude not way off. Differentiation, now this is directly from the company, food with integrity, sourcing, customizable menu. You want to start thinking of that assembly line, if you will, digital strengths, operational simplicity, things like that. I think this is a little simplistic. It's a bit more complicated. Food with integrity is the market, one of their marketing slogans. Customizable menu, it's slightly misleading. You don't customize the menu, you can pick and choose. Digital strength, I don't think their digital strengths are as big as they think. Operational simplicity, I think that's overdone. So, but on the first pass, I was like, not bad, not bad, I like that. All right, industry and competitive landscape. US fast casual, all right. I'm gonna write down in my notebook fast casual because I'm not 100% sure the difference between fast casual and other areas. Maybe you do, but in this case, I'm gonna assume I don't. And traditional QSR, and I'm gonna write down QSR. What's QSR? That is quick serve restaurant. All right, McDonald's, Yum Brands, which is Taco Bell. Oh, all right, so this is, they're growing faster. This is true, growing faster than the QSR. All right, good to know. The QSR change. Now, I still might not know what QSR is. You could type that in quickly into your, you don't even need a chatbot. You can do that with Google, quick serve restaurants, but they define it here as Taco Bell, Qdoba, Panera, Shake Shack. Now, what's really funny is in a minute, they're going to talk about the quick serve restaurants being Qdoba, Panera, and Shake Shack. So it got this one wrong. Those are your fast casual peers, but Taco Bell and McDonald's are your what we call quick serve. So this thing's not 100% correct. And then it says with indirect competition from Wendy's, McDonald's, Wendy's, and Taco Bell, by the way. So there it's like, okay, not bad. Remember at first pass, I don't need precision. All right, then I'm going to come back to Porter's 5 forces because I'm going to ask that question again. But it did offer Porter's 5 forces, which I think is always a great way to think about the competitive landscape. I'm just skipping it because I'm going to go back and ask that more directly in a minute. All right, financial profile. ChatGPT is probably a little aggressive, sucks at numbers. It's certainly not its strong suit. You know, revenues of 10 to 11 billion is helpful because it scales in my mind that this is a big company, but lack of precision is not really going to help me. Double-digit growth, I kind of implied that. The big boss already implied that. Okay, helpful. Same store sales, look, I'm going to really need to look at that more closely. Restaurant level margins, 25 plus. That's out of context because I don't know if that's good or bad. I don't know restaurants that well. Helped by menu pricing power. I'm going to write that down. Do they really have pricing power? All right, ROIC, high teens, reflecting strong unit economics. More than $3 million average unit volume. That's AUV. Again, you might have to type that into Google. Just, hey, by the way, what does that mean? And 700 to 800,000 restaurant level EBITDA. May write that down. Interesting, but I'm going to use a different tool for all the numbers. Balance sheet, net cash. All right, good. No franchise. Oh, that's interesting. All right, no franchise. All right, pretty good. Remember, I'm now 15 minutes in and I'm starting to get a profile of the company. That's pretty cool. All right, growth drivers. Unit expansion, goal is to reach 7,000 restaurants. I'm going to write that down. They're about 3,500 today. That's order of magnitude correct. It's a couple of quarters out of date. Digital, 35% of sales, digital delivery, strong loyalty program. It ends up that's not that true, but it's not going to hurt you at this point. Menu innovation, limited but impactful. Quesadilla, they don't have quesadilla. You can order quesadilla, but it's not on the menu. Brisket, I wouldn't be the one I'd go to, but it's interesting. So that one they get wrong, but again, not going to hurt me. All right, international, early innings, mostly North America now, potential optionality abroad. I'm going to write that down. Mostly North America, great. They're almost exclusively North America. But this one, again, not perfect, but it's not going to hurt you. All right, great. All right, risk, commodity inflation. All right, that's good to know. Avocados, we went through a period where avocados were expensive. Beef, dairy, highly volatile. All right, it's good to know. Reminder that their inputs are fresh ingredients. Labor, wage inflation, true. Unitization risk is 0, but I guess at some point, but it is 0. All right. Operational execution, food safety issue was 10 years ago, remains a reputational overhang. I disagree fully, and I think that's an easy one for you to check because I suspect you eat at Chipotle or you know people that eat at Chipotle, and you can ask them that in 5 seconds. You can text that to your buddy while you're looking at it. Hey, I know you eat at Chipotle, do you worry about food safety? And he or she would write back, no more than any other restaurant. All right, competition, saturation risk. That one, I am delighted that came up because I do think that that is the critical issue. It doesn't say it's a critical issue, but at least it lists it. All right, I like that. Consumer trade down in recessionary environment. Also important because fast casual, which we'll see in a minute, is a higher priced menu, a higher priced meal than the quick serve restaurants. Valuation historically trades at a premium. Sort of don't care about ChatGPT's take on valuation. I'm going to do that work on my own. All right, I thought this was really interesting. Catalyst, long or short. Now, you don't know the company, that's the setup here, but the fact that ChatGPT offered that with nothing more than a prompt that I want an investment recommendation, I thought was pretty nifty. All right, long side catalyst, sustained 10+% unit growth in North America. That's actually true, by the way. International proof points, we'll see. The domestic footprint's so big that it take a long time for international to have much of an impact, but it really just says proof point, not bad. Digital channel expansion. It ends up that one's not that important, but not going to hurt you. Margin expansion from operating leverage. This is an interesting one because they've done just a spectacular job of expanding them. I know this. They've done a spectacular job of expanding their margin to the point where it's quite possible that they're operating at near perfection. You wouldn't know that. So that's one. All of those are interesting. You could take those. They give you more things to investigate. None of them are going to hurt you if there's a little bit of an error. The second thing I thought was really interesting, short side catalyst, weak traffic in recession, consumer slowdown. That's a good point to have in mind. Food safety, brand risk, I think so. Low probability, but I think so. Margin pressure from wage food, very good. Multiple compression if growth decelerate, absolutely. So this is a B+, A- slide. And remember, my prompt was 2 lines. So I thought, damn, this is pretty good. All right, valuation. Now, I've really come to believe that the general purpose models are not great at numbers. And so when I get to numbers from chat, I'm just gonna, look at them, but I'm gonna go do my own numbers. That's why I said I want 2 tools. The general purpose model, in this case, I was just using chat 5.0. You could use any of them. You could use a couple of them, whatever. When we get to numbers, I'm gonna do my own. Oh, sorry, the second tool was I'm gonna build my own model, and I'll talk about that in a minute. All right, DCF consideration. I'm like, damn, that's pretty good. Long runway of unit growth, but valuation assumes sustained high teens ROIC. By the way, they're wrong on their ROIC, and double-digit revenue. For sure, the second one, they're actually in the low 20s for their ROIC. The comment's not going to hurt you. It's inaccurate, but it's not going to hurt you. Relative trade, richer than peers. That's true. I'm not sure I care. So this one is not one that's going to drive. I look at it, so far I've gotten a big bang for a very small prompt. This one, I'm going to do I already know I'm going to do my own work on the numbers. So I'm going to look at it, but it's not critical. All right. And then I thought this was just terrific. At the 8th bullet in my recommendation, analyst angle. I was like, all right. I'm just going to remind people, I did a very simple prompt. All right. Bull case, rare category killer and fast casual, true. Self-funded growth, true. Pricing power, generally true. Strong digital ecosystem, I'm not so blown away, fine. Long runway for unit growth, certainly has been, we could ask that. Could double store base with attractive ROIC. You got to read that sentence carefully. That they're saying is it could, the bull case would, if they could double their store base with an attractive ROIC, the stock's a good, that's going to be a winning stock. Bear case, valuation leaves no room for error. It was true, the stock's come down 30%. Consumer slowdown or execution slip could compress multiple. Absolutely true, but that's kind of a generic. Labor, commodity inflation could hurt margin. True, kind of a generic. All right, positioning. This is the great hedge. I thought this was the chat GPT hedge. Long if conviction in structural growth plus unit expansion story, especially in growth-oriented book. I love just the language of the industry. And short if you expect consumer slowdown or multiple compression. So yeah, that's the hedge. I mean, both are true, but not very helpful. All right, so that's the end of kind of what I got with a very simple prompt. And frankly, I was blown away. I'm not looking, as Andrew said, and I'm going to highlight, we're looking for improving the process, adding productivity. I'm not looking for conclusion. This has set me up. I can read through all of it. The prompt took, I don't know, 30 seconds. The response, they respond in 40 seconds. And I can read through all of this in 10 minutes. And I already have a frame, somewhat generic, but a frame at Chipotle. I'm like, all right, that's really impressive. All right, and then summer for the PM. I'm not going to send this to my PM, but I'm just curious. Chipotle is structurally advantaged. I generally agree. Premium fast casual for sure, with significant unit growth runway. That's the thesis, though. By the way, that's what we're going to come to. Pricing power to some degree, digital leadership. However, now that's the PE is wrong, but fine. The stock is priced for perfection. Was priced for perfection. Remember, it's down third. All right, so positioning core long if you believe in durable double-digit growth and global expansion. That's not a bad statement. I think that's sort of true. We got to go challenge that thesis. I'm not taking the summary from chat, but I like the setup. Tactical short if consumer weakness, cost inflation, or a comp deceleration hit. Now they are seeing some comp deceleration. We're going to do that in the numbers. All right, so I was like, not bad for $20 a month and 15 minutes of my time. I'm pretty impressed. All right, so there's your 5-year stock. This has been a big stock up to the top. It's really gone sideways now for all of 25. So that's where I stop. I hope you have some experience at this point to say, all right, I like all of that, but clearly something's going on. Investors are concerned about some things. I need to ferret that out. The boss has already said this thing's down 30. Is this something we should be looking at? Is this an opportunity, or is there some things going on that are more permanent? All right, so 20 minutes in, I could start having, if the PM, if she stops in after lunch and say, how is it going? You say, actually, great. I will definitely have something for you tomorrow morning, maybe this afternoon. All right, so freeze for a moment. I thought, I haven't talked to Wall Street. I haven't read any of the Wall Street analyst letters. I haven't done my own financial analysis yet at all. And I'm starting to get a picture that, if you don't have experience with Chipotle, should I trust this? I have a lot of experience with Chipotle, and I say it again, B+, A-. 15 minutes in, and structured in a way that I understand the issue. Okay, great. All right, there's your 1-year chart. All right, now, if I do a quick headline review, which I don't need, I use Google for, there was a big announcement a year ago where Scott Boatman, the CEO, was replacing, Brian Niccol had resigned. Now, Brian Niccol, you don't know this yet, and I'm going to ask the question, but Brian Niccol was the one that really drove the company post the norovirus issue of 10 years ago. You don't know any of that, supposedly, but I do know, just a quick thing, I had a CEO change a year ago. All right, well, that's important to know. And you stop me and think, all right, that's about when the stock started to peak out, interestingly. I was like, all right, wait, write that down in your notebook. Cool. All right, so Boatwright was announced the interim CEO a year ago. Oh, I now see that that later that year, 10 months ago, he was named a permanent member of the board. So they did a short interim. All right, so now I stop and I say, all right, let me go to chat and say, compare and contrast Brian Niccol and Scott Boatwright in their management experience, philosophy, and vision for Chipotle. Why not? All right, this is where you get. Now, here's something that's interesting, is because how the model was trained, it being chat, believes that both Brian Niccol and Boatwright are still at Chipotle. So that's the first thing I noticed. I say, oh, all right. So it's out of date in that sense. Good to know. But I'm still curious what it comes up with. All right. So who is this Brian Niccol guy? He was the CEO since 2018. If we go back and look at the stock, it was a monster stock while he was there. And he was the former CEO of Taco Bell, so industry experience, background marketing, branding, product innovation. All right. So that he's kind of a marketing guy. Cool. He helped drive Live Mas, the Taco Bell thing, Doritos Locos Tacos. He did a terrific job at Taco Bell. And if you wanted to go down that rabbit hole, you could, again, with ChatGPT, very easily. Now, I put that on hold because if we're not going to move forward, I don't need to. All right, who's this Boatwright cat? All right, he's the chief restaurant officer. He's the chief operating officer. He's been there from 17, so they really work together. He's former Arby's, again, terrific experience. Restaurant operations, P&L accountability, and processes at scales. All right, so Nichols is kind of Mr. Outside, branding, marketing, leader. He's done a terrific job, and Boatwright's his internal guy. Now, I firmly believe that some of the best companies in the history of the US are companies that have a very strong CEO, very strong chief operating officer. Disney, when you had Eisner and, oh God, the guy's freeze. When Cap Cities, Buffett always says the best run company in the history of the US, Dan, my God, freeze, Murphy and Dan Burke. So I like that structure, but I know we've lost Niccol and we only have Boatwright. Now, Boatwright's really an execution guy. Tim Cook-ish, if you will, and Nickel is more of the Steve Jobs type. I said, all right, well, Jobs, Cook's done a good job at Apple. They haven't done a lot on the product innovation, but maybe this really is just an execution story at this point. All right, put that in the back of my mind. All right, go a little bit more. Nickel is kind of brand first innovation, digital marketing, and Boatwright is operations, culture, training, food safety. All right, so I at least now know that Nickel's kind of played this promotion, brand, innovation role. Boatwright played the internal execution. I've lost Nickel. Is that important? Don't know. Write that down. All right. Now, vision for Chipotle, Nickel was the growth at scale, targeting 7,000 restaurants. All right. Chat said that they have about 3,500. 7,000's come up twice in its response. So I'm going to write that down in my notebook. All right. 3,500. The target 7,000. Well, if this thing can double, then why wouldn't the stock double? Now, at the end, you have a terminal value, blah, blah, blah. But that's like, wait a minute, this is interesting. Now, Boatwright is really an execution guy. All right. Now, I got at least, if the big boss wants to move forward, I'm going to have to wrestle this to the thing, is losing Nickel that big a deal or not? By the way, he went to Starbucks. All right. Complementary roles. This is, again, Chat's out of date. It thinks they're working together. And I think that this is a very good insight, but dated, and we've lost Nickel. Okay, great. All right, summary. Nickel provides Chipotle with strategic vision. Boatwright ensures execution. Great team, but we've lost part of it. I've got to write that down and say, well, if we decide to move forward, I'm going to have to do a deeper dive on management. But all I did, simple prompt into, the prompt engineering is clearly part of the AI story. This was a simple prompt, and I learned a lot. Again, in 10 minutes, pretty amazing. All right, so what does Chipotle do? I've been there, you haven't, you can go on the internet, do Google, get a menu, that's pretty easy. This is what it looks like. This is that assembly line where you can pick and choose as you go down the line. This is a trivial, it's somewhat unimportant, but I like it. There's 5,000 unique combinations. What it's worth, which means you have variety in the restaurant. Now, most people get exactly the same thing every time they go, but it does mean you can go with various people and they get what they want. My son and I would go when he lived in New York, and the difference between what we got was night and day. But we were both very happy, which is kind of cool. All right. So then here's one of the questions I kind of in the back of my mind. Do they really compete against, this is going to be important from a market positioning, do they compete against Taco Bell, kind of a flavor profile, or they compete against Panera? Ends up, and I don't know at this point, the Panera is fast casual, Chipotle's fast casual, Shake Shack's fast casual, although it's a burger place. All of the salad bars and the Pokies, that's mostly fast casual. Whereas Taco Bell is generally quick serve, lower price profile. Okay, great. Need to figure that out. So now I go into Chat and I say, hey, what is fast casual? Just curious. And by the way, Chat's not going to pass judgment and say, you're an idiot. Why don't you know? But if you call somebody, they might say, you don't know what fast casual is. So, you've got this assistant that's not going to judge you. So fast casual is a segment of the restaurant industry that sits between quick serve. Oh, there's that QSR, McDonald's, Taco Bell, that's correct. And full service dining, which I thought was funny, Chili's and Olive Garden. Not my idea of full service casual dining, but fine. Oh, right. All right. This now makes sense. Examples: Chipotle, Panera, Correct, Shake Shack, Sweetgreen. Oh, all right. Got it. Now you should also, because you're a consumer of the world, you should think price point $10 to $12 to $13, not, although McDonald's has gotten expensive. I don't know, last time you were in a McDonald's, not the kind of $7, $8. All right. Now I'm starting to understand that. Again, quick prompt, nice response. All right, here are some of the core characteristics of fast casual. All right, the service model, price point, right? They got that absolutely right. Food quality, fresh ingredients, ambience and experience, customization and transparency. The key to fast casual is more options. You kind of get to use the menu, the option on the menu to build your own. Whereas quick serve, it's just you take what they've got, very limited customization. And by the way, go back to the fresh ingredients. That's what makes fast casual so interesting. Digital modernization, generally true. All right. Now, I then said, how fast is the fast casual market growing? Just curious. Now, I will say this again, I may say it 20 times on this call, I don't trust ChatGPT with numbers for two reasons. It doesn't always do a good job, and they tend to be out of date. But this says fast casual is growing 11% in 2023. That's a year and a half ago. All right, fine. So it is growing faster than quick serve. That makes sense. And it's the fastest growing segment among limited service restaurants. All right, that is true, by the way. So that's good to know. Midterm outlook. I'm looking at this and like, I'm not going to pollute my brain. I'm not even going to spend time on it. All right, long-term growth prospects. I looked at this, I thought it was interesting, and I didn't love it, but it does say that the industry is growing pretty healthily. And that's important because companies should grow as fast as their industry, the very least, and the good companies should grow faster than their industry. So I'm not gonna write this down because I don't trust the AI models, to the general purpose models and numbers, but all right, good to know. I should probably figure out if I can go, and oh, by the way, this generally has links. They tend to be old and they tend to be weird sources. But in the back of my mind, I got to figure out how fast the industry is growing. I don't think that the chatbots are going to be great. That I might go to Wall Street to find out. All right, so here's the takeaway. Thought this was pretty good. Fast casual remains a compelling growth engine. Oh, good to know. Chipotle's position is well aligned with these trends. That's true, by the way. All right, good to know. Valuation perspective. Again, I'm going to ignore this because I'm going to do that work on my own. All right. So then I just say, wait a minute, before I go further, let me just find out who are the leading fast casual restaurants. So I have it in the back of my mind. Chipotle is the largest public. Panera Bread is actually almost the same size as Chipotle, but it's owned by private equity. The numbers are wrong, by the way, almost across the board. Shake Shack public, all right, Sweetgreen's public, Godobo private equity, and Five Guys, which by the way is a spectacular business, even though it's private. I've done some work on it. All right, so I have some comps, Shake Shack, Sweetgreens, those I could look at. I'm not going to look at them as a comparable to comparable. What I do care about is how fast they're growing, both in units and same store sales, year-over-year comps. Those are going to be stuff. So if I need to go forward, I've got now 2 more cases I could do. All right, write all that down. That's pretty good. Okay, cool. All right, so that I'm kind of done with the qualitative, not 100% done, but almost done with all my qualitative. Now, I'm assuming that you have access to some sort of data source, and I'm going to assume that internally there's a financial model your portfolio manager likes or the analysts use. It's not always the case, but it's often the case. And then you have access to CapIQ or Bloomberg or something like that. This is a model I use. This is the model I use in the course. This is the model I use everywhere. I'm going to walk you through it a little bit because I'm going to show you some of the analytical tools I do. But in this case, I have spent half an hour. I have a good sense of what Chipotle is. I have some questions for sure. Now I want to go look at the numbers, augment it. This is non-AI, but you don't have to use AI for everything. Just use it for the good stuff. All right, so I don't have this program because I don't have access to CapIQ. Paul Sonkin, who I wrote Pitch the Perfect Investment with, he's taken his version of this model and he's added all the links to CapIQ. So all he has to do is type the name or the symbol in the upper left corner and I'll populate. So I'm assuming I did that. All right, so I have built here an it's technically an 11.5-year model. You could build a 5-year model, whatever your organization really likes. And this is my start table, my valuation table, if you will. Here's what's interesting. Post norovirus, starting in 17, this market enterprise value has gone from 7.4 billion to 81.4 billion. Now, remember, I know in the back of my mind that Boatwright came in 17 and he's the execution guy. So I'm going to look at what the margins did and stuff like that. And Nickel came in 18 and he's the vision guy. So I was like, damn, these guys did a good job. I also know, we'll come to it in a minute, that the stock's down 30%. Something's going on. So now I'm actually more intrigued. I'm like, this is interesting. Hey, boss, I like working on this. All right, so we're down, in this model, I'm down 26% on the enterprise value. The stock's actually down about 30, but just the way the numbers worked out. Okay, all right, so I'm just gonna walk you through a little bit, it's pretty straightforward. Share price and shares outstanding, that get you, and adjustments for the balance sheet, that gets you the enterprise value. That's what we were just looking at, just so we can see where that comes from. Now, here's something that I think is really interesting. The way I do my model is I price the year the day after they report the fiscal year. So if they, in this case, they reported on the 4th of February, they reported the fiscal 14 year on the 4th of February at the end of the day. The stock then traded all day the next day in response to that release. It gets priced on the 5th close, and that resulted in a market capital enterprise value of just shy of $20 billion. $19.6 billion. So that is consensus. I've captured consensus expectations about the future value of Chipotle on that day. All right, walk through it again. I price the day after they report their earnings because I want that information to trade in the market. Some people say you should wait a couple of days, let it really seep in. I make life easy. I price at the close of the day after they report. This information's been absorbed into the market. And now I have captured investor expectations, consensus estimates, consensus expectations for the value of Chipotle on that day. I then can walk this through every year, all the way through. Same thing. So in the fiscal year 2017, they reported on the 6th of February 2018. The next day, the stock trades with that new information in the market. I captured that price on February 7th close. And I had, this is the bottom, by the way, I had a market capitalization of $7.4 billion. This is when I got interested in Chipotle because the stock got beat up and it looked cheap. And so that's when I started following it very closely. All right, that's norovirus. It went from just shy of 20 billion down to 7.4 billion. And then you saw what happened after. And then this was this year, this calendar year. They reported again on the 4th of February. They report that first week of February every year. Just the way it fell was the 4th. I priced it on the 5th. That was near the high of the stock. We had a market capitalization of $81.4 billion. By the way, you could do this quarterly. You could do it whatever you want. I just do it annually. And then what I did was I repriced it last week as I was building the case. And the numbers the numbers I'm using is through the June quarter. But you can see that your market capital, enterprise value is down to 60 billion. All right, pretty cool. Now let's go look at the profitability. I downloaded all this. This should have taken only a couple of minutes as I walk through it quickly. Now I'm educating as we go, explaining. You could quickly look through this. 20 minutes in, you have a pretty good picture. Here's your operating profit. It's actually right now it's 13.3%. In the peak in 14-15, the reason I want to go back to 14-15, that's pre-norovirus. I want to see what the business was like then. And you have these margins of just 10.5 to 11%, pretty impressive. They're now at 13.3. Like, whoa, they've actually expanded profitability from pre-norovirus. I really tip my hat to them. All right, quick check. Oh, I'm sorry, I went the wrong way. Quick check. Oh, wait a minute. We did have a tax reform bill in Trump's first term. That dropped the statutory rate from, call it 38% to call it 24%. Oh, all right, hold on a sec. Before I get carried away, I was pretty excited. Let me look at operating margins. Operating margins actually at 16.6 are below where they were in pre-norovirus, but food safety is an issue now. And it is definitely more expensive for them to deliver the product because they've had to add a safety overlay. You may not know that. You could do a quick check. You could ask Chat. I did not do this. You could ask ChatGPT what has Chipotle done in food safety. You could type that in if you want and get, I would guess, a pretty good answer. All right, so I'm looking at this. It's not quite as profitable as it was before, but in the back of my mind, it probably is a bit more expensive because of safety feature. All right, good to know. All right, so I just said, hey, wait a minute, here's kind of a fun thing. Let's ask Chat, what are the productivity enhancements at Chipotle from generative AI? Because there's a lot of stories I've been reading, and I'm assuming you as a young analyst would be reading as well, this idea that we're going to see productivity gains at companies from these models. So I thought, why not? Let's just see. I'm not going to go through these. If you want, you can go back and look at it. I think we make the slides available, whatever. And just sort of stop and say, all right, those are things. If they get implemented, at least initially, that could impact profitability. So in the back of my mind, if we're going to go forward, the big boss wants to move forward on this, guess what? I may go do some work there. And this may be a set of questions I end up asking the company. but I've got a nice list. The first ones are operations, next customer experience, third corporate. All right, good to know. Get in my notebook, follow up if I need to. Okay, pretty cool. And then you got risk management and strategic value creation. All right, that was kind of cool. And then they did a quick summary. All right, great. All right, next thing is I'm kind of an EVA guy. I'm just curious. I have built this into my model. Presumably, if it's important to your company or organization, you built it into your model. And so just, EVA, I just stopped and said to chat, what's EVA? Very good answer, by the way. It's a measure of a company's true economic profit. There's the formula. It gave me the formula exactly like that. I thought, oh, not bad. All right, that was good. So if you didn't know EVA, you did this, but presumably you knew that. All right, and so I calculated this. Don't worry about the table. Here's the chart. Here's their annual EVA. And you can see what's really impressive is that once this thing started to go, the EVA really expanded beautifully. And that was a big driver of the stock. Those of you that aren't that familiar with EVA, I do think it's a very good tool. Basically free, you program it, you put it into your spreadsheet. Very good tool to monitor, particularly long duration investing. Long duration investing, the compounders, things you're trying to hold on to for a number of years. Now, LTM, just so you know, LTM is last 12 months. I've literally, it's 6 months from calendar 24 and the first 6 months from calendar 25. So there's a little bit of an overlap, but look at that. Your EVA stalled out. That to me would be my first red flag. All right, that's important. Again, I just have this programmed in my model. I'm just looking through the charts. This isn't something new. And then there's your incremental. Oh, I have a typo. I have, you always find the typos when you give the presentation. Incremental annual EVA, and you could see that actually in 24, it looks really impressive in 24, but this thing is actually stalled out for a couple of years. Now, was that a telltale sign? I don't know. I'd have to do more analysis, but boy, for a free chart, right? Free chart it's built into your model. It's like, oh, holy smoke. Well, something's going on. Now, I've spent the first part of the analysis getting pretty pumped about the opportunity. Now, as I start to look at the numbers, non-AI, I'm like, all right, wait a minute. There's definitely something going on. Now I can see why the stock's potentially down and why the big boss is asking. All right, here's the return on capital analysis. That's been impressive. You look from 19 forward, 8-2. It dips in 20 because of some accounting. All right, 21, 22, 23, 24. I just have the calendar years here. Wow. All right, that's what's driven the stock. So I now know EVA is telling me that the incremental return is coming down. All right. Boy, 45 minutes in, I'm starting to get a very good, with the help of AI and a good robust model, I'm starting to get a very good picture pretty quickly. Now, you break out your return on capital to two components. One's called profitability or margin, the other one's scale. It's just two pieces to it. So then you can chart this. I chart this in my model, and I can see the NOPAT margin is actually expanded beautifully from 20, but it's stalled out in the LTM. All right, so note to self, go check out what's going on with the profitability. My concern is that maybe they've reached peak profitability. Okay, and then the scale is also starting to come down, which unless you know the model and take the class, you'll know the model. The scale says that actually the business is getting a bit harder. All right, interesting. All right, so now I'm thinking, all right, well, return on capital is really important. So let's do a competitive advantage. So I'm going to go back to ChatGPT. There are three models that I like. One is Michael Porter. One is Bruce Greenwald from Columbia Business School. And one is this new one that's kind of emerged. Mobison says this is his new favorite. I was talking to him a couple of weeks ago. We're having an event with him next week at Fordham. And he said he's really focused on this willingness to pay idea. So I thought, all right, let's just go ask ChatGPT. So Porter, put in Porter, and you're going to get your 5 forces pretty quickly. Threat of new entrants, low to moderate. Nobody can replicate this model. That I promise you. Now, you do have some substitutes we're going to get to in a minute, because food is food is food, but no one's going to be able to get into the business at the scale they do. Right, that's pretty good. Bargaining power of suppliers, moderate. It's really that inflation component. All right, you would read through this. All right, you make some good notes. Bargaining power of buyers, I'd say non-existent, but you do have a little bit of competition for sure. Threat of substitutes, high, right? Food is food is food is food. So, all right, they've got scale. No one's going to be able to replicate the business model. I like that. But, you've always got competition for consumers' mind. All right, there's no switching cost, substitutes, of course. Consumer trends. Now, health consciousness and customization actually favors them. So that's not bad. All right, and then 5, rivalry is intense. There's a lot of competition in the food business. But I do know, and you didn't know before you started, but I do know this has been a spectacular business. They clearly have executed well. I do know historically they had these 2 excellent managers. We've lost one, back in my mind. Is that related to the stock or not? I don't know, but I'm going to have to kind of maybe chase that piece down. So I quickly look at the Porter 5 forces. They did a very, you got to love ChatGPT, put it into a nice little table for me. You look at that and say, all right, not bad. All right, so I shift gears. Now I just put in, analyze Chipotle from the viewpoint of Bruce Greenwald. And so Bruce has a very simple model. They're effectively, they're missing one, but it gets captured in the demand and the supply side, economies of scale, cost advantages. We tend to think of Bruce having 3, but this captures them. And it just kind of gave you the quick definition. And then it goes and it looks at Chipotle, scale economics. It nailed this. It got it very well. That was really terrific. Operating leverage, it got that very well. I was impressed by that. Ignore the numbers, but it got that well. I thought that was very good. Demand side, I thought it got this very well. It did a terrific job on this. So from Bruce's, Greenwald's the model I use. I trained with Bruce. I contributed to the book on this. So this is where Paul spends all of his time. So when I read this, I was like, I'm impressed. They did a terrific job. They even got network effects correct. Most people on Wall Street don't know what network effects, although that's one of their favorite phrases. This nailed it. So I thought that was good. And then regulatory, yeah, there aren't any, it got this right. So for Porter, I'd definitely give it a B+. I don't agree with everything, but I thought on Greenwald, a solid A. I was like, very good, very good. And then execution. I thought they nailed this as well. So Greenwald, they give it a solid A. Porter, B+, A-, not bad, not bad. All right, and then it put this into a nice little table for me. All right, willingness to pay. Now the idea is willingness to pay is what's a customer's, in theory, the maximum amount of customers willing to spend for a Chipotle offering. So it gives you the quick definition. And I thought they did a terrific job here too. Willingness to pay is shaped by food quality, brand, convenience, customization, health perception, digital convenience. All very good. And Chipotle does very well on that willingness to pay. Here are some of the drivers. You can go look at that. I thought this whole competitive analysis stuff, as good as anything I've seen on Wall Street, to be honest, and less confused. Here's a couple other factors that you could go look at. And then competitive positioning. I thought this was really terrific. Wow, impressed. Strategic insight. This was terrific. Terrific. Affordable enough to attract repeat visits, premium enough to maintain high margins of brand equity. Terrific, terrific. All right, so I was like, damn, that's better than I am at competitive analysis. All right, and then conclusion, I thought this was terrific. So really great. All right, so now I did the quick, kind of quick model that I have access to. It should take only a couple minutes to populate your model. This is back to what Andrew says. If you have a good process, this fits in. So I did some qualitative analysis. I have a very good handle on what Chipotle is. Maybe an hour. I don't know. Financial model, maybe an hour. I have a very good thing, and I have a nice model to talk to the big boss. Now, this is where the financial model, in my mind, gives us some really cool insights. This is something I call the Italian Cookie Valuation methodology. I'm going to take a sip of water. And no one knows how we came up with this name. I'm convinced Sunken came up with the name. He's convinced I came up with the name, but it's stuck. And I'll show you why in a minute. Now, that's an Italian cookie. We've never had one. They're pretty good. I invert it just so you can see. And we take yellow and we turn it to blue because yellow is a terrible color to graph with. So that's my attempt at creating the true Italian cookie. All right, so this is something in my model. I don't have to do it, but I'm looking at what are sort of the key valuation metrics. Invested capital, that's what's invested in the business. Then earnings power value, that's as if the company never grew. It's the no growth value. It's based, I'll show you in a minute, it's based on no PAT profitability. The difference between invested capital and earnings power value is evidence of competitive advantage. So we call that the present value of competitive advantage. And then enterprise value, which is easy. We know where that comes from. And the difference between earnings power value, the no growth value, and the enterprise value, I'm sorry, I probably said that wrong. The difference between earnings power value, the no growth value, and the enterprise value, the total value, is growth. So we call that the market implied value of no PAT growth. All right, so this is where we get, I do an ROIC analysis. You saw that already. That's where you get your scale. That's where you get your no PAT. So I use no PAT to calculate, I use invested capital to do the invested capital layer. That's exactly the historical invested capital. Yes, there are flaws. It's historical. There's no intangibles. We go into details in the course on that. I'm not going to today. Next, I take no PAT and I capitalize that at the cost of capital. I'm lazy, so I use 10% rather than some other number for cost of capital. I use no PAT divided by 10. That gets my earnings power value. The difference between those two is the present value of competitive advantage. These are all nice. The tables, the charts are better. All right, so there's your enterprise value. We got that from the top table. I dropped that in. The difference between your enterprise value and your earnings power value. Boy, I have that wrong on a couple of slides. It's inverted. It's enterprise value minus earnings power value. That's my market implied value of growth. There's your earnings power value as a percentage. It's 27. I'm running through the tables quickly because the charts are way more interesting. So I'll show you in a minute. There's your market implied value of growth at 10%. All right, here's the charts. So there's your EV, enterprise value over time. We saw that in the table. I think visually it's way more interesting. That's why I would call this, I'll show you in a minute why I got the name, the Italian cookie, but visually I can see exactly what's happened. All right, there's your Italian cookie. Those are your three slices, the invested capital, present value, competitive advantage, market implied value of growth. All right, that's kind of interesting. There's your earnings power value, and that's increased by 900% since Boatwright and Nichols took over. Pretty impressive, pretty impressive. There's your market implied value of growth just on top of your earnings power value. Hard to see that way, so we'll just graph it by itself. That was increased by 12-fold while these guys were running the show. That's the stock. The combination of the increase in earnings power value and this increase in the market implied value of growth, that's why the stock went up. Now, that's interesting. It's increased by 8 times, but you can see that's down a lot. So the market implied value of growth has shrunk. Investors are not convinced that Chipotle can grow as fast as it was growing. That's what the charts tell me. So that's interesting. Now, if you want to look at it as a percentage of enterprise value, just to get a better sense, you can see that this thing was very stable. Now, in 2020, the market got crazy, so everything went up. But if I just do a quick glance across, hold on a sec, quick glance across this, 80 to 85% is where the market implied value of growth was for effectively 10 years. It bounces up a little bit here and there, but it really never got below 80% until recently. So this tells me in my chart, this is in my model. I'm not doing a lot of extra work. I'm just flipping through my pages. I say, all right, I got it now. That you're starting to see is a breakdown in growth and a breakdown in growth expectations in the stock price. I now have, within 2 hours, I think you can do this in 2 hours. I have a very good idea what Chipotle is. I have a very good idea what the issue is. And now I could actually do more of a deep dive depending on the appetite of my portfolio manager. Now, here's a fun little factoid, something we've discovered. No one else discovered it, so we get to take credit. Market implied value of growth rate, the implied growth rate is the market implied value of growth percentage times the discount rate. I'm using 10%. So this just captures this. So the implied growth rate is the lowest it's been since 17. All right, now remember what chat said long, if you believe they can double the number of restaurants from 3,500 to 7,000, this is gonna be a good thing. This is the numbers. Chat was directionally correct. I didn't care about the numbers. I was gonna do my own numbers. So I'm like, oh, I see what happens. Expectation for growth is starting to shrink. That's gonna be the area where I have to focus. Okay, cool, I like that. I just said this in words. All right, there is your implied cash yield. That's just current NOPAT divided by the market. I think I used Notepad to enterprise value. All right, so the implied cash yield is the highest it's ever been. This stock is cheaper than it has been on a current basis since 17. So now I understand why the big boss is probably interested and said, hey, wait a minute, let's go figure this out. I'm starting a couple hours in, maybe 3 hours in. I am starting to figure out what the issue is. And the nice part is ChatGPT allowed me to get the qualitative stuff up to speed very fast. And my model got to be able to do the numbers very quickly. All right, like that. All right, let's just do a quick comp with the S&P 500. Here's the S&P 500 earnings. There's the market implied value growth and earnings power value for the S&P 500. There's earnings power value for the S&P 500. There's market implied value growth. It's like, wait, that's sort of stalled out for the last couple of years, but that has not. So a lot of people say the market's more expensive. Yeah, no kidding. There's your earnings power value. Earnings power value is a no growth steady state. If that's all I ever earned from the S&P 500, what would you pay for? And then there's growth. There's growth expectations built in. All right, so there's your earnings power value. It's down to 34%. The chart goes back for 15 years. It's the lowest it's been in like 25 years. Here's that just stacked in blue. There's your 5-year average or 10-year average. There is your market implied value of growth for the S&P 500, the highest it's been by definition in 20 years. So this is an expensive market, by the way. Now it is dominated. I mean, it's a whole nother lecture. It's dominated by the Meg 7, blah, 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 blah. But as an overall, this is an expensive market, at least by history. All right, pretty cool. There's it all stacked up. Pretty good. All right, so if Chipotle is going to trade in line with the S&P 500, we can tease out how fast it has to grow, because market implied value growth right now for Chipotle is 73%. Market implied value growth for the market is 66%. So if Chipotle's market implied value growth is going to shrink, but we want to make money, we need to grow our earnings power value to represent 34%. And here's your math. It's 34 divided by, it's the target EPV percentage divided by the current EPV percentage. And then however many years you have, I said 10 years. So if Chipotle can grow faster than 2% a year and ultimately trade in line with the S&P 500, we make money. So I'm intrigued. Now let's do some quick things. I know I'm probably out of time. I'll do the last couple of things fairly quickly, just the other analysis. Here's Chipotle's restaurant count, just so you could see. The ChatGPT said about 3,500. It's a year old. It's right just shy of 4,000, so-called 3,900 units. Here is the comps, which the company reports. You can see that the comps have gotten worse. All right, so this thing really is slowing down. I've got to figure that out. That's the crux of the issue. I've seen the valuation. I've seen the description. I now know, hey, guess what? The crux is growth. Not surprising. There is the revenue, quarterly revenue divided by average number of restaurants. This you'd have to go do a little bit more work, but you probably could get this from a sell-side analyst pretty quickly. You can see in norovirus, they were doing $409,000 per restaurant per quarter. So call that about 1.6 million on an annual basis. They grew that to 838,000 per quarter. So 3.3, I think it works out on an annual. That's come down in the last 2 quarters. But there's been other periods where that's come down. So I look at that and say, oh, is that temporary or real? That is the crux of the issue. Here is your by channel. This is the digital revenues and stuff like that. There's the chart, just so you can look at it. Now, this you'd have to go do some work. You probably could call a sell-side analyst and say, hey, do you have these numbers? They would send that over. That's certainly not something I would trust ChatGPT. You probably don't have that in your base model because it's unique to Chipotle. All right, so here is some additional work I've done just so you could see it. This is sales rankings in the industry. This is something the work you would have to do as your next generation work, because you're going to do it against base rate. So that's the revenue compared to other companies. That's the revenue per store compared to other companies. And there is the number of restaurants compared to other people in the industry. Remember, the target is 7,000. So I then went back to ChatGPT and just said, what are the revenue growth drivers for Chipotle? I thought this was terrific. This gave me a good frame of the work I'd have to do next. All right, and then the international expansion. They have done 2 announcements, but remember, there are 3,900 restaurants. How many Restaurants outside the US have to open before they move the needle. I thought, all right, interesting, but probably irrelevant. All right, here's another chart that I've created just to look at the source of revenue growth. Now, here's what's interesting is that the target that management has set is 7,000 and they're at 3,800. All right, so I just look at this from a base rate and said, boy, if they got to 7,000, they're in the same world as Burger King and Domino's and Pizza Hut. And I stop and say, oh, wait a minute. That's not trivial. I would need to do some more work because 7,000 sure feels like a lot of restaurants for Chipotle. But I now am beginning to be able to frame this and cobble together a quick pitch for my PM. Not much into it. Now, I'm not going to go into this, but I have done in the past density by state, restaurant density by state, and it looks like 4,500 to 5,000 is probably the theoretical limit. I would say 4,500. You're at 3,900. They're opening 300 a year. We're going to start to slow down. So this been able to sort of frame pretty quickly, call it 3 hours, Chipotle, go in and talk to the big boss and say, this is what I've been able to do. It's clearly growth. Saturation is an issue. We lost the key management. You put some things together. Stock is cheaper than it has been. It's kind of trading in line with the S&P. What do you want me to do? And she may say, go do some more work. But I think if you have a good, robust process, you have a good financial model, generic for companies, which is easy to do today with the data sources, and ChatGPT, I think you can get up to speed on this really quickly. And she might say, have you talked to Wall Street? No, I want to do this. Great. Now go read the Wall Street research. You have a framework now to read those research reports without being completely batted around because they are persuasive. They may be wrong, but they're persuasive. But now you can reach out to the Wall Street analysts and say, hey, you know, what's the story on Chipotle? What are the issues? And you now have a framework to ask good questions. And you spend the afternoon talking to some people on Wall Street, maybe get some comp data from them. And by the morning, you're ready to write a 1-page, 2-page, 3-page report, whatever the big boss wants. And so that's kind of the little exercise today. The case, walking away from it, I've been very impressed with what I could do with a $20 a month product. I can get up to speed on things very quickly. Now, we're going to do another one of these webinars in 2 weeks with Brett, and he's going to do it from a slightly different angle. He's going to do a more in depth. I think it's going to end up being more in depth, specifically on United Healthcare. So you see the tools in a slightly different way. All right. Questions?
All right. Well, thank you for that, Paul. Looks like we have a couple of questions from the audience. One is, this one's on prompting. What were the prompts used for Greenwald and willingness to pay?
Now, let me give you two answers. I spent the last, I don't know, 2 weeks, I'll call it that. I've taken an online course or a lecture on prompt engineering. Brett and Andrew had a really terrific webinar on Monday, I dare say, on prompt engineering. I do some consulting for another company, and we're working on prompt engineering. And it's clear that prompt engineering is an art, not a science, but there's some science behind it. Push all that aside. My prompts were shockingly what the AI world calls naive prompts, simple prompts. I literally said, tell me Chipotle's competitive position using Bruce Greenwald's framework. That's all I wrote. Give me Chipotle's competitive position using the framework of Michael Porter. And then the last one I said, using willingness to pay, give me or I probably did it in the same order just to be consistent. That's it, simple sentence.
Actually, it might be a good time to mention that, the first part of the program of today, we walked through the use of AI to get ramped on different aspects of a company. Now, this is a good first cut, get a sense of landscape, debate, structure. The numbers are not really reliable, but you can kind of get through that at the second pass. Once you get a model together, you have it integrated, you can kind of see what has been likely driving the changes in market implied value growth. Where could margins go from here? How do we feel about doubling the store count? and things like that. So you can see today there's kind of an integration of having a structured look at ramping on a company and then augmenting that workflow using AI. Now, if you're interested in learning about how to develop a workflow, or whether you're looking to refresh your process or get another look at other types of processes, a great place to start would be the Wharton Applied Value Investing course that we're doing. Incidentally, we're also going to be including some AI content that Brett and I have done, and that will also be part of the course, so you can kind of see the analyses come to life through the use of different tools. So just a reminder for that, the course will begin in October. Moving on to the next question, it looks like one of the attendees asked, what information did you input beyond the prompts?
Nothing. I'm going to give it slightly, nothing is the correct answer. I did not put in any 10Qs or 10Ks or any of that for all right, I'll say 3 reasons. Number 1 is I wanted to do a simple case just to see how it would go. 2, I'm going to do my own financial analysis, and it's a little strong. I just don't trust ChatGPT to do financial analysis yet. There's some really terrific products starting to be developed that are very specific to investors. They're not cheap, where they have taken and added a layer to deal with structured numbers. ChatGPT does a wonderful job with unstructured language, and I will argue, Paul Johnson, not Wharton, not Wall Street Prep, not Andrew, I will argue it does a terrible job on structured data, ironically. But I don't need it to, because I have a financial model that does all my structured data for me, all my structured financial data for me. But now you do need as Andrew said, you need a process and you need a model that you like, both of which I have.
Okay, it looks like we've got a few more questions. All right, one question. Let's revisit the definitions of something that came up earlier, which is what is meant by present value of competitive advantage? How is it calculated? And also, how is market implied value of growth calculated? I think we kind of hop, skipped, and jumped through those as we were getting through the webinar. Maybe let's just revisit that.
Okay, take the course. No, look, I'm being a little flippant, but yeah, no, these are things that we've developed that we're sharing in the course. And if you're industrious, you see that I have a web series out there. I don't want to compete with the course because I think the course is better than my web series, but a cheap version is I have a web series out there called The Value of Growth, and I go through all of these things. But I'll give you the quick definition. Earnings power value is defined. Graham got this wrong. Greenwald got this wrong. It is the steady state, no growth value of a company. If you believe that the steady state will last forever, you can use the perpetuity valuation formula, which means you take whatever your estimate of perpetuity cash flow or NOPAT is, and you divide that by your discount rate, and that is your earnings power value. All right, enterprise value is the value of all future cash flows as dictated by investors. So the difference between your earnings power value and your enterprise value, who's got to be growth, which I label as the market implied value of growth. I call it market implied because it's dictated by the market capitalization of the equity. That's what investors believe. Now, in earnings power value, there can be a layer of earnings that is delivered from excess returns, return on capital greater than your cost of capital. That's going to attract competition. So if you believe that that NOPAT level is going to hold and they're going to be able to defend those excess returns, it means you believe the company has a sustainable competitive advantage. So that layer between invested capital and earnings power value reflects those excess returns. So we refer to that as the present value of competitive advantage. The Italian cookie is a wonderful tool, and you should get to know how to use it.
Just going through this. Hey, actually, Paul, have you tried working with the deep research mode, or do you prefer the shorter single prompt kind of one-shot answers?
It's a very good question. And the answer is, the more I play with it, the more I like smaller, shorter prompt, iterative. They sometimes call that conversational or one-shot, repetitive one-shot. I like that better. I think this idea that you put in this long prompt and you want the output, I'm not convinced that, well, me personally, Paul Johnson speaking, my own experience, I'm not convinced the quality of that is as high as if I do very specific, particularly in this area, very specific. Now, I got that overview up front. I thought that was a terrific framing. I love that. I didn't know what to expect. I just put the prompt in and said, let's see what we get. I thought that was terrific. And then what I want to do is go back to each of those bullets separately and then ask for it to do more on that. But investing is a tricky thing. Number one, the model's out of date. And number two, it doesn't deal with numbers very well. So I want it to give me stuff where it's really good. The competitive analysis was spectacular. I thought that was really good. The management stuff was very good, but out of date. Some of the other things were pretty good. As a first pass, there was nothing in any of the responses that would hurt you, given the way I framed the exercise.
All right, this is a bit of an interesting one. I'm happy to chime in on this one too. So about how many years of experience as an investment analyst would you be asked to create an analysis such as this? So effectively, this is actually something we go through in the applied value investing course. You could be a pretty junior analyst, maybe even fresh out of banking, and your PM says to you, take a look at the stock and let me know what you think. And you're gonna need to go through not just understanding the company, its competitive position, taking stock of the now, but then also taking the temperature of what expectations of the future are reflected in the stock. And so doing that requires a little bit of, tinkering, a little bit of structured analysis. And those are actually some frameworks that we explore in the course in a way that has currency in institutional investment seats. What would your take be, Paul?
Yeah, if I talk too much, I'm going to detract from an excellent answer. I'm going to reiterate what you said very upfront. To do well in investing, either professionally or not, you need a process. And without a process, it doesn't matter what tools you have access to. It's like being a carpenter. Unless you understand how to put wood together, it doesn't matter how great the tools are. And I feel strongly here. What Brett, Andrew, and I are spending a lot of time is say, hey, wait, here's a process. Their process, my process are complementary. We just have different approaches, but very complementary. And we're both trying to think about what are the tools out there that can augment that process. So back to your direct question, how young? Frankly, I think number one, I think the course is terrific, obviously, but we designed it, so of course we. But I think if you go through that course and then you get into what we call reps, doing it again and again and again, and you don't need AI to be a good analyst. And what we teach in the course is a process that you can follow to be a good analyst. We think to be a good analyst. Now, it's like anything, you got to practice and get good at it and faster at it and more precise at it. We're now looking at, what if we take this new tool that is effectively free, can it augment parts of the process? And we believe it can. Can it replace the process? I don't think right now it can. Will it? I don't know, we'll see. But right now it can't replace the entire process. That's why that deep research question, you can't just put in, hey, my PM's asking about Chipotle, should I tell her buy or sell? And put in some more stuff in the prompt and it comes back with an answer. I think, and Andrew, you can comment, I think we're finding that result is a hit or miss. But pieces along the way can be quite powerful.
Got a good question here. Thanks for your time and teaching us new forms of using AI. I have two questions. Number one, how can I verify AI-generated financial data when numbers like revenue or EPS may be off? Do you have any other AI tools that are more accurate, or do you have to build your own models? And two, how do we avoid confirmation bias when prompting in ChatGPT so it doesn't just tell me what I want to hear?
Well, second one first. ChatGPT, confirmation bias is a problem in your life, so you're always dealing with that. Ask generic prompts. Don't lead the witness. And then the best way to deal with confirmation bias is to delve into things you don't agree with and find out why did it say that? Why does it believe that? Why, what are the counterfactuals and things like that? The first one, I think Andrew's going to give a different answer, and I very much respect his answer, but we have a different experience. For the moment, I'm not going to use ChatGPT on numbers. I'm not going to use any of. I'm not picking on Chat. That's my go-to because I'm intellectually lazy. But I'm not going to use any of the chatbots for numbers. And I don't need to, because I have this other wonderful data source, CapIQ. And then I can go to Wall Street if I need to, presumably if I'm a shop with access to Wall Street. at some point, it is possible that you can. I don't think we're there yet. But as I said, there's some pretty impressive people trying to solve that problem.
Yeah, I mean, maybe where I'd weigh in here is on a couple of fronts. One is we were able to gloss over some of the numerical outputs from ChatGPT because there was a vetted data source that you could reference elsewhere. So there's that backstop there. So it's not foisting the entire workload on ChatGPT there, where it's probabilistic. It can't really calculate. There are a whole host of problems with that. So the information just lived somewhere else. Now, what can be interesting is sometimes ChatGPT may surface a number that is incorrect, but it clues you into some important KPI disclosed by the company, and you can validate it yourself against that. You'll note that the outputs that we saw that got the research started then progressed into putting them under a magnifying glass in the model and seeing what they actually are. This was not an exercise of copying and pasting outputs from the chat window itself. Additionally, adding validation layers for AI is something that is coming up. You'll see companies like Delupa that are now partnering with some of the major general purpose models to provide exactly vetted, fault-free numbers so that these tools can be applied by investors. So it's worth mentioning that this is a snapshot and point in time, but it does also underscore the importance of understanding where the tool may be used and areas where relying on the output of the tool is going to get you in trouble. We had an interesting question. This is actually an interesting little suggestion. Got this one from Hewitt, who says, thanks, Paul. Suggestion for next version of this, a chart showing the DuPont formula using EVA's OPM, capital turns, and capitalization. This page may help pinpoint faster changes in the business or how the board of directors is allocating capital.
Agreed. Thank you.
Great, and then we got another one. So here's an interesting one. Isn't it easier to use investor relations and various filings to get the basic overview and data than using 3-year-old figures and lots of inaccuracies? To me, too many things stated were either outdated or incorrect. The analyst may not have the experience to spot and correct all issues. It's certainly true that things are a lot easier when you're, QCing the output where you kind of have familiarity with the underlying, so you're not, treading water in the deep end. However, there are certain things. So drilling down into the company's own financials is something that was addressed later in the course, or later in the lecture, sorry. And the other element is trying to understand some of the other players. So is it the best return on time to go into the K's, Q's, and press releases of each company to construct what's generally going on when you're looking to pull a specific data point? Well, relying on chat is not going to be, your batting average is going to be mixed, let's say, but being able to pull numbers from elsewhere can help you cross-check some of these assertions. So the way that a lot of people are navigating this is requiring that there be sources provided for each number quoted. Even then, it's not going to be perfect unless you have a very well-connected, unless you have a robust link between the chat and the underlying data, which is what we see with some of the data providers doing as they partner with the general purpose model companies. Let's see. All right. Here's a question. Is there information that you can get from AI that you think can be 100% trusted?
Well, by definition, no, because it's probabilistic. But are there things that are in the 95? Let me answer the question. Let me just change the question and give a better answer. Not a better question. The question was good. Can you add AI to your process such that you can tolerate answers that are not 100% correct? And that, to me, I think is the goal. Insert it in parts of your life and parts of your process where you don't need 100% for it to be of value. But I don't think we'll ever be at 100% because by definition, it's a probabilistic mechanism. Now, can I get to 99? Probably 95. Sure, but if I have a situation where I don't need 100% and I'm just trying to do stuff quickly, or it's helping me in some ways, productivity, then Wikipedia is clearly not 100%. Google's not a, when's the last time you had a source that was 100% of anything? I think Cap IQ, for me, truth is 10 Ks and 10 Qs, but we don't always have time. But if we're going to get serious about a stock, I'm going to download it from Cap IQ, but I may go check the numbers into the filing because Cap IQ does stuff.
Yeah, there is.
What do you think? Wait, before, go ahead, yeah.
I was going to say, in terms of the meta, the frameworks, things like that can be interesting, but that's more illustrative of kind of the physics of something. That's not really illustrative, or the relationship between things. That's not a specific data point like what was Q2 17 gross margin at Chipotle. It's probably going to fall. It's probably going to unravel or fall apart trying to answer that. But there are. We talk about this in some of the webinars we do, that sometimes the capability of AI tends to improve as the difficulty of the query increases. So basically bombing on the basic questions and then sometimes surfacing some interesting responses to questions that are declaratively more difficult. It actually ties in nicely to this question, which is, would you say that as of today, the role that AI plays in an investment process is mostly as a tool to accelerate qualitative analysis?
Oh, absolutely, for sure, 100%.
Yeah, I mean, we there are some conversations that we've had with institutional investors who are using AI. They're things that are at kind of the cutting edge or bleeding edge right now would be AI hazarding, maybe imputing a judgment for where consensus could go based on novel information as it emerges. Now, there's a key distinction there, and it's why a lot of the AI tools for public markets and private markets are not, mutually usable. In private markets, you've got a data room and you're trying to get through all the machine readable data in the data room to get to the answers to your questions. But the way public markets work, I mean, we saw the market implied value of growth. The market implied value of growth can change, and this changes based on expectations. So it's kind of, what you're looking for is things that can change your expectations as a public markets analyst, which makes you a difference engine, as one of our interviewees put it. And so what you're trying to do is, anytime something crosses your screen, you're trying to assess if it's material, and if it is material, then how number moving is it? Some of the leading edge cases that we've seen for AI are beginning to have a first cut on where numbers could be headed based on something. However, that still remains very much in the minority of use cases, and for the general population, that's generally not, the tools that people are using are not really able to do that. But it's evolving.
Yeah, stay tuned.
Yeah, stay tuned. How do you determine the strength of the executive team, not trusting the prompt completely?
Oh, well, listen, I've thought about that problem for 30 years.
We covered it in our course.
Yeah, exactly. Long before AA came along. Yeah, it's I'd argue it's got a big component of art, and we cover it in the course. Hey, this is free. We can have commercials. Can't we have commercials some way through the thing?
It's we didn't get a jingle together in time, but the when you are assessing management, you want to understand management's incentives. How does management get paid? What business outcomes steer the payout that management could receive? What are they likely to do based on these incentives? What are they unlikely to do based on these incentives? What has been their historical track record? Is this management the right management for the task that is before them? Is this, does the ship need a navigator, or does it need repairs? It depends on the current state of the business, and you need to assess the prospective profile fit of the management team. Is this the right person for the job? Or if they're not observably the right person for the job, how bad can it get if they aren't the right person for the job? But we actually have a number of modules on assessing management, and it goes back to AI is not a substitute for a process, and understanding what you want to look for is the biggest part of the lift. And that's something that we go over in the course in much greater depth, but certainly understanding incentives, which some of them are found in the proxy, the DEF 14A filing. You can look at what metrics influence the pay of management, and you can also look at the scenario in front of them. I'll give you an example. Sometimes management is incentivized based on sales. Well, if you're incentivized on sales and not operating profit, then you can sell $1 for 90 cents and jam the sales number and collect a sweet payout to the detriment of the company. So you got to make sure that the incentives are aligned. And Paul has some great content on evaluating management in the Applied Value Investing course. Next, we have, this one comes up every webinar we do. How much do you weigh macro factors in your evaluation?
I work backwards. I try to get to know the company, and then I work and say, what are external forces that could affect the company out of their control? And I put that in the macro bucket. And there are certain macro things that I've come to realize I'm never going to be good at. Interest rates, commodity prices, Fed policy, stuff like that. And those, as you work back, or I don't know if you work backwards or not, but you start small and go big, and you say, holy small, banks. I don't do banks. I don't know anything about banks, but it seems to me that interest rates impact that. If that's if that macro element is critical to getting your idea right, and it's something you can't really do, move on to the next idea. Or if your PM is insisting, just say, hey, listen, unless I'm wrong, I'm sure we gotta call the interest rate thing right to get this right. Is that true? Yeah. Well, then go talk to somebody else on the team, because that's not my strength. So I always work backwards, get to know the company, see what the drivers are, and then start to say, well, wait a minute, what are the external forces that could help or hurt them? And how difficult are those to track, monitor, predict? How important are they? So that's how I work.
Yeah, the management locus of control is pretty important. Looks like we have time for one more. I'm just going to let's see here. I guess, have you ever tried having ChatGPT ask you creative questions you should be asking yourself as you pursue your analysis? If so, was that exercise worthwhile?
I'll give it a two-part answer. Number one, I have not, and number two, I think it's really clever. And then number three is, if it's really clever and you haven't done it, how come? Because there's 24 hours in the day, and I need 7.5 hours sleep, an hour and a half of hygiene.
All right. Well, we gotta land the plane sooner or later. Thank you very much, everybody, for your attendance and participation in today's webinar. We do have one more webinar coming up in a couple of weeks, which will be on AI and United Healthcare. That one will be led by Program Director Brett Caron. And remember that we are going to explore a lot of these topics, if not all of them and more, in the upcoming Applied Value Investing program, which starts in October. For more information, check the Wall Street Prep website.